Hello, everybody. So last week, we did not just see the equity markets being carnage. There was a little bit of damage to debt funds as well, and specifically to liquid and very short duration funds, something that you would not expect, in turbulent times. So look at the returns that we have here. Last week saw liquid funds give almost nil returns. That essentially means that for the last 2 to 3 days, it did deliver some negative returns, just wiping off the rest of the week's returns. And you can see the other categories have given up to about 50 bips negative returns. You can see that the weekly returns of liquid funds, a sharp fall there last week. Similarly, the other categories of low duration ultra short funds also saw negative return over the past week. Now, there have been quite a few factors that have impacted the debt market. I'll just like to, kind of list them out and tell you what you can do about it and whether you should worry about it at all. So, the first factor is that we are in March, which is typically a financial year end, and which is when corporates, pay their advance tax, and they do withdraw quite a bit of their money that they've parked in liquid and very short duration funds. And there is usual redemption pressure, and mutual funds are usually, well placed to address it. But given the additional issue, the pandemic corona virus issue that we are facing now, that has caused us some more, kind of requirements for corporates, and it's likely that they are withdrawing a lot more than they usually would. So that has been causing redemption pressure. And what happens when there is redemption pressure is that fund managers do sell some of the instruments at prices lower than ideal that they should have otherwise got, and that results in a spike in yields and a fall in the prices, and therefore your NAV fall. So that's one of the primary reasons. The second, needless to say, foreign institutional investors have been selling not just in equity but also in debt, and that is reflected in the net outflows that's been happening over the past week and actually month to date in debt as well. The third thing that has been happening is that yes, remember there was a change in the dividend distribution tax law, and that kicks in April 1st, which will basically see many investors moving from dividend options to growth option. And I reckon sure about this, but I reckon it would also cause some kind of a hit in terms of redemption that happens. The fourth thing that is, kind of happening is that more than half of the universe of liquid funds have a maturity of over 30 days, and those instruments are marked to market. These kind of spike in yields changes actually result in a volatility in the instrument prices, and that is reflected now in mutual funds because they have to be marked to market. Broadly, these are the reasons. Should you be worried about it? You should be worried a bit, but not too much. The good news is that we are not seeing any credit risk in these instruments at this point in time, or as a category, we're not seeing large credit risk. There is liquidity issue, but the good thing is this: RBI is addressing the liquidity issues through open market operations, where it is infusing liquidity. It also announced 30,000 crore of such an operation over two tranches this week, and that will bring in some liquidity. And RBI has promised to do more such. The other thing, of course, is that um, we will, of course, come April 1st, we will have SEBI's guidelines, which basically says liquid funds should have about 20% in very liquid instruments, government securities, treasury bills, and so on. That will also help give more space for any redemption pressure that mutual funds may be facing without the rush to, selling instruments at very suboptimal prices. So there are positives. The negatives will continue. Some amount of selling pressure, some amount of redemption. I mean, we should not be surprised because if corporates get into this mode of not being able to operate because of the pandemic that we have, there will be tight working capital requirements, and they may be dipping into their treasury money. So some kind of volatility should be expected. As far as you are concerned, much would depend on the situation in which you are. If you're just holding liquid funds, ultra short, for over 3 month period, you don't need the money at all, you shouldn't be worrying about it. Just allow it to settle. But if you're in a situation where you need more liquidity now, you don't have sufficient balance in your bank, and you think there will be an issue with, say, a salary cut, or there is an issue of, losing job or any such, we don't know. As things move, we will get clarity on those. It is better that you have more in your savings bank account or in very short term FDs. There's nothing like cash. Cash is king. So try to have as much as possible your emergency money, your immediate requirement in your bank account, and leave the rest with the liquid or the very low duration investments. And of course, make sure that you are geared for some amount of extra volatility, simply because these instruments are going to be fully marked to market, which basically means whatever the market moves are, the same will be reflected in your liquid funds. So expect some more volatility, but don't worry if you don't have any immediate requirements. Stay safe.